It's time to get started. Thank you for your patience. So welcome to this webinar on tracking the alpha of private fund managers and using the privateMetrics tools and the global league tables that we built using those tools. So I'll show this to you today. I'm going to proceed in 3 steps in this presentation. First, discuss a little bit why we might want to measure the alpha of private funds. This might seem a new thing, or maybe something that's not necessarily done in private markets. So we'll discuss that, and then we'll show you how to measure the alpha of funds using the privateMetrics tools and indices, specifically looking at buyout funds. And finally, we'll put all that together into our recently published 2025 GP Alpha League table. So again, looking at buyouts and which managers and which funds have been performing the best over the past 10 years. Okay, so first, why do we want to measure the alpha of funds? I'm going to talk a little bit about why this is really an important matter, perhaps more important than it might seem. It goes beyond the question of fund selection, of manager selection. The problems, I'll summarize briefly the problems that we all know about with IIRs and peer groups of IIRs to select funds, and highlight what the solution is, which is to use an index, and in particular, a private market index. And I'll show you briefly, because we've already had a webinar on this a few weeks ago, how the proof of concept of how using the index that we produce actually is the best way, the most robust and the most convincing way to measure private market performance relative to that of funds. Okay, so first, why is it interesting? Why does it matter? As you know from your first risk management class, probably, asset allocation is the first order question when it comes to risk management and portfolio management. You have to get the asset allocation right, and this will determine 80 to 90% of the results. And of course, that's the case if fundamentally you can buy asset classes and you can combine them in a portfolio. But with private markets, it's not exactly the case. You cannot actually buy the private market as such, the way you would with an index fund, for example, in the equities market, in the public equities market. Instead, you're going to end up investing in private markets probably through a collection of managers, perhaps directly, and investing in small portions of a much larger private equities market. So you're never going to have really in your portfolio the entire private market as an asset class. You're going to have a subset of that. And so which managers you select and what in the end will make the difference between success and failure in terms of allocating to private assets will depend greatly on that, on selecting the right GPs. Because if you select the right GPs, you may actually secure exposure to private markets, to the risks of private markets. And second, you may in fact even beat private markets and receive some alpha, or not. So, and depending on which managers you select, you could be selecting a few managers that consistently underperform the private market, in which case, in terms of asset allocation, you are completely failing to allocate to this asset class. And when it comes to manager selection and GP selection, today we know that the process remains highly qualitative, and also relies a little bit on using IIRs and quartiles and stuff like that. And I'll come back to this, but it's mostly qualitative. And this is something that's not good enough anymore. It's not good enough because private assets are a large part of portfolios, institutional portfolios. They also are now increasingly present in wealth management and retail products. And so not knowing really if you're selecting the best managers, not knowing really if you're getting really your money's worth in terms of investing in this asset class, and in particular not understanding the risks and what qualifies as good enough performance is heavily problematic. Okay, so apart from the qualitative aspect, which is the brand of the manager and the relationship you might have with them, etc., or also the process that they might have, all the things that a manager would present as part of their added value, there is the traditional, I guess, approach, which is to look at IIR peer groups. And we're not going to redo the entire webinar that we did last month on how peer groups of IIRs are fundamentally unreliable. In fact, this is fairly well known. The fact is that when you use peer groups of IIRs, first, there's a fundamental problem, a kind of conceptual problem, which is that you're not looking at performance attribution. So you can't tell the difference between the performance of the market and the performance of the manager. And so you can't really tell why the IIR is what it is. Is it because this market in which the manager is invested performed really well, or is it the market maybe performed not so well, but the manager was very good at delivering returns? Conversely, maybe the returns are not so impressive, but maybe the manager actually only delivered the returns of the market, in which case you might say that it's less of his responsibility, certainly not his failing. Except perhaps for having picked the wrong market. So this question of performance attribution is completely obfuscated by looking at IIRs. We don't know where the returns are coming from. And then so this is a conceptual problem. And then you have a more of an empirical problem, which is that there is no robustness in this data. And again, this is well known, and we've demonstrated this previously in previous publications and webinars. If you use available IIR data to build peer groups and try and have quartiles, you fundamentally cannot know what the right quartiles are, what the level of the quartiles are. There's not enough information. Even if you had all the raw data available, it would still not be enough, usually, for a given strategy, for a given type of fund, to have robust numbers. We equated this in a recent paper on, basically, it's the equivalent of gambling, because it's so difficult to know whether you're in the top quartile or not, basically, when you have 20 data points or 30 data points. Even when you have 100 data points, it's fairly difficult to know from a statistical standpoint. So using IIR peer groups is really not that helpful. It is unfair. It's often unfair to the manager. So some managers might end up in a low quartile when actually they're delivering great alpha, and this is something that we find. They might end up in the wrong peer group because there's not enough data, or the data is very noisy, etc. So it's unfair, and it's also dangerous, because from the LP's point of view, especially if you understand that selecting managers is the private market equivalent of asset allocation, since in the end, that's all you're going to get. You're not going to get the entire private market in your portfolio. It's dangerous because you don't really know what you're doing. And so as an allocator, it doesn't sound very responsible. Okay, so what's the solution to this problem? The solution is to use an index. And that's actually almost self-evident. If you have a market index, and the question then becomes, does this index exist? But if you do have a market index, which is built to represent a market, by definition, it must be representative and it must be robust, because an index is not built with 5 or 6 or 10 data points. And as I'll show you, some of our indices are built with thousands of data points. And so if you have an index, all you need to understand whether a fund is a good fund or a bad fund, or not so much a bad fund, but whether it performs well or whether it underperforms the market, is the index. And you don't need a peer group, you don't need data about other funds. It's much simpler, in fact, to implement, and it's much more robust if you have a market index. So this is the intuition behind the development of public market equivalence. This is something that's fairly old as well. It's been around for 20 years, which consists of saying, well, let's take a market index. So let's take a listed index, listed equity index, and adjust the cash flows of the funds to see how they perform relative to this market. The problem is it's not the right market. So it really doesn't tell us that much. The PMEs, the public market equivalents, are not that interesting. They're not that informative when it comes to selecting good managers. They are informative when it comes to comparing asset classes. So it tells you something about whether investing in private equity, in this fund in particular, is a better idea than investing in an index fund, an ETF, for example, a listed equity fund, because, well, that's what you're actually comparing it with. But it doesn't tell you whether this manager is any good. And it's possible that for the risk that they take, many private equity managers will outperform the public market, but it doesn't mean that they're the best ones by any stretch of the imagination. That's because public equities and private equities are two very different markets. The public equities market is very large, much larger, but it's also consists of many fewer companies. In terms of geography, in terms of sector distribution, it's completely different. In terms of who buys and sells, and therefore what the price dynamics are, it's quite different. There are many buyers and sellers that are present in public markets that are not present in private markets. And so it's pretty difficult to say that you can proxy private market dynamics with a public index. And there are many examples that are dear to us, and particularly on the infrastructure side. For example, listed infrastructure, which does exist, is very, very different from unlisted infrastructure. It's very difficult to argue that you can proxy the unlisted infrastructure space using listed infrastructure companies because there are so few of them and they're only in a few sectors and they're only in a few countries. But it's also true in many other sectors by which the structure and the dynamics of the private markets, and especially in terms of firm size and types of firms and types of firm ownership and dividend payout behavior and all that kind of stuff, which eventually determines performance, is very, very different in private markets than it is in public markets. So we need an index to solve this IIR problem, or this fact that there's not enough data, and also that we want to be able to differentiate between market performance and manager value add, but we can't do this with a public index. What we need to do this is a private index. So that's why we produce private indices. That's why privateMetrics offers this solution to access benchmarks that are both representative of private markets and that are granular, so that they can be customized to represent the performance of a given fund, but also capture the dynamics of the broad private equities market. And this will then allow the users of this data to calculate alpha for individual funds and to compare individual funds. So I'll show you this in a second. We call this the private market equivalent. So it's the kind of revised version of the PME. This will allow you to exactly separate how much the return of a fund occurs because of the market and how much is the value that a GP has added through their skills, through their asset selection process, through their structuring process, all the value that they can create, and some of them create a lot of value, on top of whatever the private market for private companies delivers in terms of performance. Okay, so in order to validate this idea that you could use the privateMetrics indices, we have a recent paper where we look at funds, buyout funds. We take 800 buyout funds over a decade, and we calculate the alpha of these 800 funds, and we find that on average, there is zero alpha. There is, on a net basis, after fees, there is no alpha on average. And to me, this is a great proof that this is the right index, that this index captures the right market, and that this is the one against which you should be comparing these funds. Because first, it makes perfect sense for the index that represents the market in which these funds invest, in other words, the average performance, to be pretty much in the middle of the distribution of the performance of all the funds. In other words, about half of the population beats the average and the other half underperforms the average. That's the definition of an average. And so it should be this way. Another reason why this is convincing is because if you look at the economic and financial literature on this particular question, whether there is alpha in, for example, mutual funds, hedge funds, all sorts of active equity funds, usually most of the papers, there's particularly a very famous Farman French paper from 2010, find that there is zero alpha on average, precisely for the same reason, because it's very hard to beat the market. Some people do it, some people don't do it, and on average, the market is the market. In other words, it has to be the case that the average outperformance is very close from zero, very difficult to distinguish from zero over a period of time. So in this paper that we published last month, we had a webinar about this a while ago, but you can also download it here. We show this. We show that the average alpha of hundreds of funds is actually, this picture is for 437 funds. These are funds that have returned all their cash flows. So there's no question of whether it's the NAV that's driving some of this calculation of the alpha. It's just pure cash flows against an index. and the median alpha is 0. And what this shows is not only that the median is 0, but that many managers do beat the market and sometimes continue to do that. We'll come back to this. They have persistent alpha, but many do not beat the market. In fact, they underperform the market. And so that's what we wanted, right? We wanted to calculate the private market equivalent of funds in a way that is robust, and that's the best way to select funds. Okay, so that's kind of the very briefly the kind of theoretical and conceptual framework around this. Now let's apply this. So we're going to look at the privateMetrics tools. They've been made available in Excel and amongst other platforms, but Excel is probably the most obvious one. So I'll show you how this works. First, I'll remind you of the approach that we take to calculate alpha, which is the direct alpha methodology. I'll show you briefly what the Private 2000 market index is. So this is the broad market index we're going to use to calculate total alpha. And then I'll show you how we can build a custom fund benchmark, which captures the strategy of a given fund or a specific fund. And as a result, allows you to calculate something we call pure alpha, which is the performance not only above the broad market, but above the specific market in which the fund is invested. And with all this information, we can then score the funds, we can rank the funds, and we can create league tables. So we'll come back to this. First, the approach. So we have this notion of alpha, total alpha, which is simply how much a fund performs over the return of the broad market for private equities. Okay, so to calculate this, we're going to use the direct alpha methodology, which is a very standard methodology. It's been used now for many years. And the direct alpha methodology consists basically of adjusting the cash flows of the fund in input, rather inflows and outflows of the fund, and taking into account the net asset value, the remaining net asset value, to calculate the equivalent of an IIR, but it's not an IIR, it's now an alpha because you've actually modified the cash flows to reflect the performance of the market. So it's a very simple, very elegant approach, and it allows them to compare funds on a like-for-like basis because you remove the effect of whatever market they're in, and you're just comparing the added value of the managers. So this total alpha, we can then break down into two parts. We can calculate it again, but this time not against the total, the broad market index, but against a customized benchmark. A benchmark that represents the style of the manager, the geography of the manager, that represents the sectors in which the manager invests, something that, and I'll show you how we can build it with privateMetrics, something which is granular enough, but also robust enough to really represent the strategy of the fund. And so whatever performance the fund delivers above that is really the pure alpha, the pure skills, in fact, of the managers. And of course, the difference between the two, the delta between the outperformance against the broad market and against the benchmark of the fund strategy is what we call allocation alpha. It's simply the difference of performance in the end between the strategy and the total market, right? But this is also called alpha because in the end it is a choice. The allocation strategy of the fund can be, effectively chosen by the manager. It's also in a way chosen by the LPs in the sense that they select the funds that have a certain strategies. So whatever strategy they've put forward, for example, to invest in X% in this sector and Y% in this other sector, and to invest in this country but not in that country, et cetera, all of these things are allocation choices which determine the reference for the pure alpha calculation, but also define the allocation alpha. Right? Okay, so now let's look at the index that we're going to use to calculate total alpha. So the first type of alpha. We're going to use the Private 2000 index, which is an index we have now been producing for a year, but goes back 10 years. So SIPA has been producing indices for more than 5 years now, but this is something that we've launched a year ago. This index tracks 2,000 firms in 30 countries, 30 major investment countries for private equity funds, but it tracks individual companies and it doesn't track funds. It's not an index of funds. Once again, it's an index of companies which we reprice every month thanks to an asset pricing model. And we reprice them every month to reflect the latest level of market prices. If you want to know more about that, we have another seminar and papers that explain our asset pricing methodology. But in a nutshell, it consists of using market prices, available market prices, so for the fair value of private companies at one point in time, to recalibrate an asset pricing model so that we can shadow price those 2,000 companies and then collapse them back into an index. And we can show that the average error is very small. In other words, we actually are tracking the average level of prices in this market. And we don't just do that for 2,000 companies, we actually do that for 1 million companies every month. So once we've built this index, it has about $2 trillion of market cap at the moment. It is built according to a completely transparent methodology, which is available on our website. It's basically a pretty boring index, I guess. It's a market index. It has index, it's regulated, it's registered with the European Market Authority. So it has to go through all the hoops. I have an index committee and an oversight committee, et cetera, et cetera. It means that every month it's the same companies in the index, but there's an annual rebalancing process, but otherwise, unlike a contributed index where you get a bit of everything, you don't really know what, because the managers would give whatever data they've got to an appraisal-based or contribution-based index. This is an index which basically tracks a representative set of companies over time. So it's very comparable to other indices, and it actually does track the market. So that's one thing. And then once we have this index, we need cash flow data from the funds to be able to measure the alpha of these funds. So what do we need? We need contribution data. So I'll show you a bit of detail. Here we have several funds in an Excel spreadsheet. We have contribution data, we have distribution data, we have a final NAV on the last date that we're interested in. We have all these different funds, and that's basically all the data that we need to calculate the alpha of funds once we also have this private market index. So we have the private 2000, we have the cash flow of the funds. We're missing a custom benchmark to represent the strategy of a given fund and be able to calculate not just the total alpha, the outperformance against the market, but the pure alpha. So to do this, we're going to take an example. We're going to use the tool that is in the Inflametrics Excel add-in to build a customized benchmark for a fund, which in this case is a mid-cap fund. So we are going to invest in the mid-cap universe, the private equity universe, mid-size. We're going to, it's 2016 funds, which starts with a strategy which consists of investing 50% at least in the portfolio in tech in North America. And then this strategy is going to change in 2020. We're going to decide to add another dimension to the strategy and try and invest at least 10 to 20% of the portfolio in European B2B companies. And so here we have, it's interesting, we have a geography and sector constraint. And we also have a geography and business model. I think it's actually what we call customer model, B2B, in the PEX taxonomy. So we're going to be able to segment the market and to create constraints like this of different kinds in order to define the strategy and then build our customized benchmarks. The way we're going to do this, we have our Excel spreadsheet. We're going to use our custom benchmark functionality. First, we need to select our universe. So we're going to go mid-market, global, pick the USD return index, universe, so that we can compare this with USD cash flows. Then we're going to select North America as a constraint. So we want to have investments in, we said tech, so that's information and communication in the PEX taxonomy, and a 50% weight. Okay, so that's the first constraint. And then because it's a 2016 fund, we're going to put a 2016 start date on this constraint. So we're going to pick the 1st of January, 2016 to be the start of the constraint in the data. So that's one constraint. Then we're going to add another one. because we know that this fund in 2020 is going to start investing in European B2B. So we pick Europe. Actually, we want to be a bit refined here. So we're going to remove Southern Europe and Eastern Europe. We could actually go down to the country level and we cover 130 countries. And then we're going to pick the B2B customer model. And here we're going to put a range of weights because we're not quite sure. But it needs to be at least 10 and maximum 20% of that. And we're going to put a date for that constraint to start in 2020, 1st of January 2020. Okay, so we save the second constraint in the system, and now we're going to query our database to build this index. So everything you've put in there is now repeated in this table. It's going to call the database and calculate this index on the fly. So it takes maybe a few seconds. Meanwhile, we can show you that there are other options here. But for example, you can get the allocations of the index. You can get all the constituents of the index. So this will be delivered in this case. And we'll show you really all the details. So there it is. Now we have an index. It's here. It has dates and an index price, index returns, etc., which corresponds to this universe and combines all these constraints. And then on the right-hand side here, you have all the allocation of this index by country, by segment, by sector, by basically all the different ways that this universe is segmented. You have weights, so you can completely understand how it's allocated. And now you have the constituents. And these the constituents which are defined here and categorized, of which there are, let's see, there are 10,032. So that's 10,000, there are 10,000 constituents in this customized benchmarks, which tracks the mid-market private equity universe of companies, of private companies, and has this constraint of having at least 50% tech in the US and at least 20 to 30% B2B companies in Europe from 4 years into the strategy, right? That's basically our index. And we also get a number of summary stats here, returns, volatility, etc. And see that this is a proper index. So that's the customized benchmark that we've built based on the definition of the strategy for this fund. As you see, we've used only 2 of the constraints that we can create. We can actually put as much as 20, so we can have something very detailed and very dynamic that matches exactly what the fund has done. And having done that, we now want to calculate the alpha of our fund. So we're going to go to a different part of the spreadsheet, select the fund data, the fund cash flow data we've got, and then do this calculation again with the functionality in privateMetrics add-in. So we have a fund here. It's fund number 6. It has this data, contribution, distributions. Now we have this direct alpha functionality. Now we're going to give it a name. So fund number 6, we're going to put in the vintage for 2016, and then we're going to select the data that we have that represents the cash flows and the NAV of the fund. And now we're going to add our market index. So we select the private market index, private 2000 in US dollars, because this is US dollars, US dollar cash flow. So we select US dollar returns. And we selected that from a list of indices. We also going to select our strategy benchmark. So we're going to use the one we just created. So we're going to pick this information not from a list of tickers, but from the spreadsheet where we created the index. You recognize this. This is what we were just doing with the customized benchmark. So now we're going to take the benchmark, the customized benchmark that we created, add it into the direct alpha calculation sort of tool, and then combine that, and we get the fund IRR. Well, that's easy to look at, but we get the fund market return, which is how much the market contributed to this fund IRR over that period of time, and what was the alpha, what's the difference, which in this case is very significant. It's 11.6. And the allocation alpha is very small, which means that the strategy actually barely outperformed the broad market. But the pure alpha, as a result, is very significant. So what this means is that this fund didn't really select a very powerful, very different strategy or a very different strategy in terms of performance, but that it really managed to outperform the market. Now let's remove this and try and compare funds, right? So we're going to keep going with the tool and add a second fund, so we can compare two funds using the same approach. So we have now fund number 4 in this sheet. We're going to select also the same thing, the data for fund number 4. And this time, instead of creating so we're going to also select the private 2000 index as a total alpha, so broad market index, same one, so we can compare directly. But here we're not going to build a completely customized benchmark. We're just going to pick another market benchmark as the strategy. For example, we're going to find a private equity global gross index, if we can find it. We see that we have a lot of options here. Voila, private equity universe, global growth, USD returns. That's our benchmark for the strategy of this second fund. And we give it a name, growth benchmark. It could be any name you want. Now we have all the information for the second fund. We press query, and now we can produce the same results, but this time now we're comparing two funds. And it's very interesting. The second fund has a much lower IRR, but it was a later vintage, an earlier vintage, 2014, and the market performed very differently. So the contribution of the market to the return is 11.6, meaning that the total alpha is actually negative. So with an IRR of 6.7, 6.8, this fund is actually underperforming the market during this period. And its strategy is also has a positive alpha, meaning that the growth strategy performed better than the private 2000. So while the strategy alpha is positive, the pure alpha in the end is even more negative, because by definition, and this has to match, right? So basically, this fund not only delivered a low IRR, but it delivered a low IRR in a very strong market and in a strategy that was very that outperformed the market itself, that outperformed the broad market. So it really didn't do well at all, you might say. And it's very different from the first one. And so here you can start to see how you might select funds based on this kind of information. Basically, once you keep doing this with fund after fund. And so we did this for this fund reports that we just released, this alpha report we just released. You can start to obtain information that's presented this way. So you have a fund IRR that's always there, but now you're breaking it down systematically between the contribution of the market to the fund IRR and the difference between the two, which is the alpha of the fund. So this is the value add, or you might say the skills of the managers on top of whatever the market returned in that period. And that's not the return of the market, and that's the return of the market times the exposure of the fund to the market. So that's embedded in the cash flows, if you want. So in this case, for example, if we look at the beta of the fund, which is obtained by deducting estimating what it is, given that we know the IRR, we know the market component of the fund return, we know the alpha, we can get the beta out fairly easily. It's an approximation, but it gives us a good idea of how exposed to market risk this fund is. So this fund is less exposed to market risk, so the market return for the same period was 11.27. The contribution of the market to the fund return is 8.7, and then the remainder is alpha. So that's already a lot of information. And then because we've also done this, we've defined a specific strategy benchmark for each fund, we can also split this alpha, in this case 5.7, into an allocation and a pure alpha. The allocation alpha, in this case, this is just another example that's in this report, is negative, meaning that the strategy that this fund was invested in underperformed the broad market. And yet they produced 5.7% of total alpha, which means that their pure alpha is even more. And so they were in a not so good market, or maybe they didn't pick a very good strategy, but in the end they performed well because they delivered a lot of value, a lot of outperformance, if you want. So once you know this, you know the pure alpha in particular, you can rank funds. So in this case, we're ranking 600 funds in this report. by pure alpha, and just based on where they are in the centiles of alpha, we give them stars. You can do it for all the funds, or you can do it by peer groups. But in any case, you get a sense of the quality of the manager skill set here, and their ability to deliver not only the market return, but better than the market return. So that's already very powerful, and it allows you now to compare funds in a very like-for-like basis. And then, of course, now that you know the beta and the alpha of the funds, you can also try to categorize them across these two axes. So this gives you a very convenient 2x2 matrix in terms of market risk, which is beta, and alpha, which is outperformance. And so we have beta on the horizontal axis, and so the funds on the right-hand side are more exposed to market risk. The funds on the left-hand side are less exposed to market risk, and then the funds at the top are deliver positive alpha, and the funds at the bottom deliver negative alpha compared to the market. And that gives you some quite interesting way of classifying funds as well. Again, to compare them, you have leader funds who are taking market risk and delivering alpha, creator funds who are managing to have less risk than the market, and beta less than 1, but still deliver positive alpha. So it's really a way of creating value beyond just being exposed to market risk. And then you have the followers. You have the funds that have basically a negative alpha, but take a lot of market risk, have a high beta, trying to get to the top, but not quite making it. And then you have a strange category of laggard funds, which have low beta and negative alpha, which are basically not very good. And so that becomes very clear who's who here and who's doing what to whom, if you want, based on the alpha and beta information that we can extract from all the funds. So if we look at funds now in terms of league tables, we have 600 funds in this report. Here, for example, we look at them, the top 10 in terms of pure alpha by vintages. So here we have the most recent vintage group, which is funds that are only a few years old, so they're still investing. And you can see that, some of them have delivered a lot of alpha. There's some familiar names here: BlackRock, EQT, sorry, Blackstone, sorry, EQT, more Blackstone, etc. Very successful funds, very high pure alpha. And of course, they will have lots of stars because they're really very much at the top of the distribution of alpha. But they have different styles. Some of them are leaders, so they deliver a lot of alpha, but they take a lot of market risk. And some of these guys are quite interesting. There are some of these more rare, in fact, funds that have less exposure to market risk, but also deliver high positive alpha. Now, if you look at funds that are the top 10, again, in terms of pure alpha, for funds that are basically invested, so the vintages 2016 to 19, they're not quite completed. These funds are not quite closed, but they've basically invested most of their capital. And you can see again that we have familiar names, and at the top of the distribution, very, very significant performance, and actually even higher alpha, pure alpha in some cases, and also a mix of styles. Here, the first one is a creator fund. It's a fund that generated very high alpha, but did not only do this by being exposed or overexposed to market risk. So that's probably an interesting one to look at. And then if we look at, again, the top 10 for all those funds that have basically returned all their capital, we see that we have, again, high pure alpha, less high than in newer vintages. So this may be because in newer vintages, the end of the distribution when it comes to performance, they're performing really, really well, even better than 10 years ago. It could be because it could be something to do with NAVs, in the sense that this alpha is calculated, if you remember, with the cash flows of the fund and the NAV on the last available dates. If the NAV that's reported today is overvalued, this may be boosting the alpha of the most recent funds. We haven't, in this exercise, we haven't adjusted the NAVs of the funds. We have a tool to do that, also to basically reassess where the level of the market is at and whether the NAVs are at the right level. But here we haven't done that. We've just taken the data from the funds as given. So your interpretation is as good as mine, whether the more recent funds have higher alpha because their NAVs are overinflated, or because they perform better because the best funds, the best of the best funds today are even better than the best of the best funds 10 years ago. Both are probably possible. But anyway, so that's what happens when we calculate alpha and pure alpha and total alpha for and beta for hundreds of funds, and we can make this kind of classification. And of course, we can also aggregate all this information to look at GPs, right? So here we have pretty much just a similar exercise, but with one interesting twist, which is since we're looking at GPs, we're looking at multiple funds per GP, and so the very recurring question in research on funds and alpha is whether the same GP is capable of delivering alpha again and again. In other words, is there persistence in the alpha of the funds, or is it random? At the moment, if you look at these results with an average alpha of about 0, if you pick the fund randomly, it's going to be 50% chance basically to get positive or negative alpha. But of course, you don't pick the funds randomly. You invest in the fund with the same manager that you invested before because you've seen their track record, you've seen them achieve something. So is it the case that when an asset manager delivers positive alpha, they are more likely to deliver positive alpha again the next time around or not? So we look at that, and then that allows us to complete basically the scoring and ranking methodology for GPs and produce a GP level league table. So briefly, how do we look at this persistence question? We're going to start with a premise or a prior, as we say in statistics, which is that we take all the managers and we each give them, without knowing any more information, we each give them a 50% chance of generating positive alpha, because that's what the average is like. It's also a coin flip, so it's not a bad prior. And then we look at each manager and each fund. And if we see a manager that delivers positive alpha again and again and again, we update this probability of 50%. And if it's positive, it will increase. So if we keep saying the same manager delivering funds after fund with positive alpha, we're going to update this probability using a very standard procedure of Bayesian statistical updating, which basically will ramp up this number from 50 to 55, 60, 60, etc. Up until if we see continuously positive alpha for the same manager, it's going to get close to 100%, because as far as we can tell, they keep flipping the coin on the same side, if you want. And conversely, for some managers, we'll see one positive alpha fund and one negative alpha fund and one positive alpha fund, and etc. So basically, it's going to hover around 50% because we don't know better. As far as we can tell, they keep winning sometimes and losing sometimes. And then some managers, they keep basically delivering negative alpha funds, in which case this probability will decrease as we observe more of the funds. Right? So this is how we estimate on an ongoing basis the probability of positive alpha, and we did this for 150 GPs. And having done this, we turn it into what we call a skill score, which is basically the probability of positive alpha of the manager times the average alpha across all their funds weighted by NAV. And we standardize this between 0 and 1, and that gives us a score, which is an indication of how skillful these managers are. And if you calculate this score, it looks like this. So on the horizontal axis here, you have the skills score that we calculate for 150 managers. On the vertical axis, you have the average NAV-weighted alpha of these managers. And you can see that there's a kind of a crowd here in the middle, which doesn't have much alpha. Some of them have negative alpha, but doesn't have much alpha, but also is kind of, in terms of scale, is kind of in the middle of the distribution. It's probably sometimes winning, sometimes losing, pretty much like most market participants. What you also see is that there's a group of guys over here who keep, who kind of escaping. Looks a bit like a bike race, if you want. They're kind of escaping the Tour de France. They're kind of escaping the main lot here. And at the moment, the yellow jacket is Patria Investimentos. It's a Brazilian manager, because they're the ones that have the highest skill score of the whole lot. And that's because we see them repeatedly delivering alpha, very positive, but also very constant alpha. Okay. So once we've done that, we can then again do this. We can kind of profile all the managers. So we can look at their alpha. We can give them a little star rating like this. Same thing based on the distribution of alpha across all their funds. And the centile of the distribution, they get a number of stars. And we can also report their probability of alpha, their skill score, etc., etc. So it's possible to do this for all these funds. And as a result, to also categorize them by star, not only give them stars. And so all these funds will have here on the horizontal axis a certain level of skills, and on the vertical axis a certain level of alpha. In other words, you have fund managers that deliver a lot of alpha and are very skillful at delivering this alpha consistently, so we call them sharks. And then you have fund managers that deliver positive alpha, but basically, as far as we can tell, it's 50-50 chance every time. But on average, it's positive, meaning that they have they've delivered some great alpha, but it's with 50-50% chance every time. So they're basically lucky managers. They flipped a coin and they ended up on the right side of that bet more often than not. And for other managers, we see also not particularly different from 50% probability of delivering alpha, but on average it's negative, so they've been unlucky. And then there's a whole bunch of managers that are here in that quadrant, which are basically tend to deliver the negative alpha and also tend to deliver do not tend to persist well, cannot persist to deliver positive alpha, right? So we call them the fishes, which are obviously the least desirable group. So if we then look at all the managers that we're tracking in this report in those terms, for example, this time by size. So if we look at the mega managers, the largest ones by AUM, you see that, again, some very familiar names here. Some have, on average, a lot of alpha. But apart from Thomas Bravo, which has very high pure alpha, average pure alpha, and very high probability of positive alpha, the average alpha of the very large managers is not very large. It's 10, 6, 3%. So it varies more. And their style is definitely the shark style. So they tend to deliver positive alpha, but we see that they don't deliver extremely high alpha. Whereas compared to the mid-cap managers, again, some familiar names here in that space, we see also a high pure alpha on average at the end of the distribution. So this is just the top 10 out of hundreds, higher pure alpha, but also obviously very significant probability of positive alpha for some of them, even though not all of them. So the first one, the one with the highest pure alpha, is actually, as far as we can tell, in this case, they delivered a very, very high performance on one of their funds. But as far as we can tell, they've been lucky. They don't have, as far as we can tell, a particular skill set which others tend to have. And then if we look at the small cap, so the last part of this this group by size, and again, there are many of them, but this is just the top 10. We see again that we have the ability to deliver high pure alpha, and for some of these managers, the probability, very high probability of repeating this pure alpha. And in this case, they're all in the shark category. So these are all very good, but they're obviously have a different type of managers. They operate small outfits, and they're more likely to be the ones that transform companies, etc. Perhaps the most standard or most classical sort of private equity investor. So in conclusion, what can you do with this? So you can actually do this at home. You can download, or in the office, you can download this add-in on the Microsoft App Store and through this for free. And then you can access through this the various taxonomies that we use and our list of indices, etc. Obviously, if you have a subscription to this data service, you can also download the indices and use them to make these calculations with and use these tools with your fund data and even create your own rankings. Why not? Because it's fairly easy to do once you can calculate the alpha and the pure alpha and of these funds and do it repeatedly for many managers and many funds. If you want to know more about the research that we've done on this sector, there's also this report that we've published very recently, which covers 600 funds, more than 150 GPs, and it's free for LPs. So if you're an LP, get in touch with us. You can get it for free. It's 800 pages of fund analysis goodness. If you're not an LP, you can also get it, but you'll have to talk to our sales team. But it's not that expensive. And we'll do, this is for buyouts, we'll do another one in a few weeks on infrastructure funds with the same approach. We'll look at several hundred infrastructure funds and the managers that go with them, compare them with the broad market index for infrastructure, which is the infrastructure 300 index, and then compare them with a specific benchmark for each fund, which captures their strategy as per the ticks segments to which they're exposed, and look at the alpha and the rankings that we get for infrastructure funds. That's pretty much it for me. If you have any questions, don't hesitate to email us or to call us. I think my colleagues will be in touch in any case. If send us an email if you want to receive this document. And of course, you can just download this add-in in Excel and see for yourself how it works. So with that, I will thank you for your attention and say to you au revoir and have a good rest of the day. Thank you.